Hi, and welcome to another economic commentary. I'm Stuart Bergman. Well, we came into spring with the wind at our backs as first quarter results were surprisingly strong across the US, China, and Canada. Even Europe, which slipped into recession early in the year, performed better than feared late last year. But as we move through 2023, the impacts of a series of one-off events, be it the unseasonably warm weather that dampened energy demand in Europe, a bumper crop in Brazil, the rundown of excess savings in North America, or China's post-reopening normalization of activity, aren't likely to continue to provide much additional support for the global economy. Now, to be clear, we're not expecting global financial crisis type patterns, but perhaps just a whole lot of nothing through the rest of this year and into early 2024. In our summer global economic outlook, we expect a significant drag on some of the key drivers behind the consumer activity that's been powering much of the momentum up until now. Interest rate hikes have already led to steep declines in real household wealth over the last 6 months, and higher borrowing costs have taken their toll on the housing market. This is going to impact consumers' mood and spending behaviors through what economists refer to as the negative wealth effects. Additionally, while consumers in the US and in Canada dipped into those excess pandemic savings to help finance their spending amid rising costs, much of that cash stash has now been depleted. And what's left of it appears to be concentrated among the higher income brackets, where the tendency to spend each an additional dollar that comes through the door is lowest. In fact, here in Canada, if you look at the lower income brackets, where that marginal propensity to consume is highest, they're actually worse off than they were before the pandemic. EDC Economics is also starting to see some deterioration in the labor market, with certain sectors like consumer discretionary showing outright declines in employment. This means that job growth should start to pull back as well, especially as higher costs, softening demand, and tighter credit conditions hit corporate earnings. And if not, and if somehow employers manage to defy the historical precedent of higher rates leading to higher unemployment, central bankers will have no choice but to make it happen. Wage growth in much of the developed world is still running ahead of rates consistent with central banks' target inflation range. While we do expect inflation to come back to target range by 2024, thanks to the lagged effects of interest rate increases, fiscal consolidation, shrinking central bank balance sheets, weaker global demand, and the moderating impact of year-over-year price comparisons, prices remain high. And so, elevated wages and stubbornly high shelter and services costs have forced almost all major central banks to continue to tighten lending conditions, with the notable exception of the People's Bank of China. Now, this poses a real challenge for central bankers, given the need to ensure price stability on the one hand, while simultaneously ensuring they're not pushing their economies into recession or igniting financial meltdown on the other. Faced with this policy trilemma, we continue to believe that central bankers are likely to deprioritize growth, even if it means an uptick in unemployment. As a result, we expect the US Federal Reserve and the Bank of Canada to hike rates once more by the fall. The European Central Bank is expected to more than keep pace under the cover provided by better than expected growth in the region. These moves will weigh on the outlook for the second half of 2023 and into 2024 in most advanced economies, especially when combined with the credit impacts of the recent banking turmoil. The anxiety that set into markets earlier this year because of a number of highly publicized bank failures has made lenders more cautious about lending, especially since we don't know what might trigger the next wave of panic. Together with the steepest hiking cycle in a quarter of a century, this will reduce the flow of credit into the system over the next several quarters and could even bring about contraction in certain economies. We expect businesses to ease up on investment and hiring in this environment as insolvencies increase thanks to the end of more than a decade of cheap money. As a result, EDC Economics expects U.S. growth to fall to 1.3% in 2023 and just 1% in 2024. Canada's heavily indebted households will also dial back spending to service higher debt costs, hitting overall economic activity and bringing GDP growth to 1.2% in 2023 and 1.4% in 2024. In Europe, we expect growth to fall to 0.9% this year and 1.1% in 2024. China will continue to struggle with the lingering effects of a property slowdown, reduced levels of confidence, record youth unemployment, and soft export demand. Authorities there will lean heavily into that economy, but remain constrained by already high levels of local government debt, managing growth of just 5.5% this year and 4.7% in 2024. And with China accounting for 32% of global growth over the last decade and a big driver of activity in developing economies, this will constrain growth across developing markets, many of which are already suffering from rising debt servicing costs, weak export demand, and limited room for governments to stimulate growth. Add it all up, and we expect a global economy that manages growth of just 2.9% this year and 3% in 2024. A weaker global demand outlook will weigh on commodity prices. We forecast West Texas Intermediate crude oil prices to average $77 per barrel this year and $73 per barrel in 2024 as spare capacity and weak demand keep prices in check. Copper prices will also remain subdued as China's demand outlook more than offsets growing electrification demand. This, together with the interest rate dynamics described above, will combine to see the Canadian dollar average 74 cents US over our forecast horizon. The bottom line? Following 2 solid years of post-COVID-19 catch-up, the global economy has hit a soft patch. While we don't anticipate a return to the lows of the pandemic period, we expect to see a drag on activity over the next 12 months before economies stabilize later in 2024. What's more, downside risk prevails as policymakers look to skillfully balance the risks in efforts to steer us into open waters. This week, special thanks to Ross Bursakovsky, Director of our Country and Sector Intelligence Team. As always at EDC Economics, we value your feedback. If you've got ideas for topics you'd like us to explore, please email us, and we'll do our very best to cover them in future editions of the commentary. Thanks for tuning in. Until next time.